What's the point of earning 0% on your cash when you can do better with short-term municipal bonds? Well, that's just one of the recommendations from Chip Cobb. He's Senior Vice President at BMT Asset Management. Chip joins us this morning. So, Chip, you've got about $4.5 billion under management in your fund. How much of the average portfolio would you recommend go into muni bonds or other cash derivatives?
Well, cash obviously is very pathetic at this point, earning zero. We are very cautious about fixed income in general, so that's why we've leaned towards municipals. We have pretty much about 35% right now in municipals. We recognize that there's credit issues. We recognize that a lot of the states have various budgetary problems, but we figure the way that the Fed has mandated a 0% policy on short-term reserves, and now they've done this Operation Twist. They're forcing the yield curve to flatten. So we've got to stay with very short-term municipals, recognize that the tax equivalent will be significantly better than what Treasury is paying us.
Are you trading in and out of stocks on a more frequent basis given the amount of volatility in the market right now?
I would say it's less frequently. We certainly recognize that there is, we need clarity, obviously, what's going on in Europe. And until that, we certainly want to see earnings, be more of an issue about why, stocks are doing what they're doing. But, we tend to gravitate towards large multinationals. We like their balance sheets. We certainly recognize that they've deleveraged far better than the majority of the small and mid-sized names. So we like the way that they're positioned, but recognize that we still have volatility here, and we have to. Even
when those multinationals make a market in China, which appears to be slowing, and Europe, which has shown evidence of going towards recession again.
The China situation, we're not nearly as uptight about. I mean, 9.1 GDP versus 9.2. I mean, recognize, yes, that is slowing, but slowing at 9% is still pretty attractive. Europe, we're certainly far more cautious than China or any of the emerging markets for that matter. So, but we do definitely like the stronger balance sheets with the strong dividend plays.
Now, we have this meeting happening in Europe on October 23rd. We're supposed to get some visibility into the next round of either structured bailout or structured backstop. Are you changing your portfolio ahead of the weekend?
No, we're not going to make any changes specific to that, because we really don't think we're going to get any real clarity out of this. We don't think, we don't really have a lot of confidence in what's coming out of Europe at all. I would love to come in Monday morning and say that we've got some type of resolution, but certainly we have no real confidence in that happening whatsoever. So our attitude is still it's going to be volatile going through the remainder part of this year. And we're still stuck in this trading range for a period of time. We have far more confidence in the latter part of next year than we do, through the end of 2011.
The energy complex is gaining today. Which energy stocks do you like?
We like a lot of the anything that's related to coal. We like coal. We certainly like some of the natural gas plays. Anything that's going to have more of a domestic holding, as our policy starts to change, with Washington.
All right, Chip Cobb, thanks for joining us this morning.